situation. Now, there may be events such as we purchase a truck. What happens when we purchase a truck? We use cash and we increase our asset or our truck. The assets haven't changed, but the components of the assets have changed. Do you see what I'm saying? There may be other times that we receive inventory on credit. In that situation, our assets increase and our liabilities increase. Make sense what I'm trying to say to you? So basically, what we're basically seeing here are various situations and what occurs in our accounting equation. So when we acquire assets by issuing equity, think about it. We issue 100 shares of stock in exchange for $1,000. What happens? Cash goes up, which is an asset, and our contributed capital, part of shareholders' equity, also goes up. When we receive assets by issuing debt, so we go to the bank and we need a $100,000 loan. Our asset of cash goes up $100,000, but our liability, the bank loan, goes up $100,000. Okay? If we are using assets to retire equity, so we want to buy back some stock. Okay? We have too much stock outstanding. So we're going to use $1 million cash to buy back some of our common stock. What will happen? The assets are going to go down, and our contributed capital, that portion of shareholders' equity, will also be reduced because we're buying back stock. We have less outstanding. When we use assets to retire debt, we're going to pay off that bank loan. That $100,000 bank loan, we're paying it off. When we do that, we use cash. That goes down, so our assets go down, and our liabilities also go down because we don't owe that loan anymore, do we? Does it make sense how every event triggers a change in the accounting equation? When we generate net income, when revenues create assets, so our assets increase and basically our retained earnings ultimately increase because we've got revenues are ultimately net income coming in. Revenues satisfy obligations. When we use cash to pay down an accounts payable, our assets are going to go down, and ultimately our expenses are going to be increased, which means ultimately our stockholders' equity is going to go down. Oh, it's revenues satisfy obligations. Okay, so revenues, so in this case, the revenues, not cash. Revenues satisfy obligations. So we're basically taking revenues, that's kind of a tricky one. Revenues satisfy obligations. So basically, we're performing revenues to pay off a debt. Okay? So if we perform revenues, instead of receiving cash, we're going to reduce something we owe somebody. Our liabilities will go down, but our revenues are going to increase. Okay? The stockholders' equity section of revenues goes up. When expenses consume assets, which means we pay cash, okay? We pay cash to pay for expenses, or let's say we have a bunch of prepaid insurance as an asset, and we use up that prepaid insurance just over the passage of time. Our assets are going to go down because we're going to get rid of that prepaid insurance, but our expenses are going to go up because now we have an insurance expense. Make sense? So our assets are going to go down, and our expense portion, our expense will increase, which ultimately reduces our shareholders' equity. Expenses incur obligations. So based on an expense, we owe money. So let's just, to keep it simple, we have a utility bill that we record. I'm just trying to keep it on a simple note here. We have a utility expense that we have an accounts payable for because we haven't paid it yet. So our expense will go up, which basically ultimately reduces our stockholders' equity or our retained earnings. But our liability goes up because we owe that money now. Gains create assets. Gains create assets because we get cash or another asset. Losses consume assets. Think of it. If this building is worth $10 million, but we only sell it for $5, we're going to take this $10 million building off our books, which is reducing our assets $10 million. We'll add cash of $5, but have our assets still gone down? Overall, they're less. When we pay out dividends, we use cash to pay out dividends. So our assets are going to go down, and ultimately our retained earnings is also going to go down because in paying out dividends, we're reducing our retained earnings balance. At the end of the period, our assets are still going to equal what our liabilities are, plus our contributed capital, plus our retained earnings, plus our AOCI. So basically, this is an understanding of throughout the year, a recording of all these different transactions all affect the accounting equation, but they're all going to balance. It's all still going to balance, and in the end, we'll still have our assets going to equal liabilities plus contributed capital plus retained earnings plus AOCI. Okay? Every single transaction is on its own. So instead of looking at it overwhelming, each transaction is going to balance, and it ultimately is still going to all equal out in the end. So basically, every economic event, not always every business transaction, because sometimes we'll have business transactions that we don't report an economic event, like I hire someone. It really isn't an economic event that occurred until I pay them. But transactions involve the transfer or exchange of resources between the company and another party. So every transaction is going to be transferring or exchanging resources between one company against another person. Events are occurrences that can affect a company. An arrangement is an agreement or a promise by the company with another party or entity. This book really separates out transactions, events, and arrangements. I am not going to quiz you on anything relating to events and arrangements because some of this is a little new terminology. The point of it being is sometimes there are events that happen that do not require an entry. Okay? Source documents are basically the business documents that record transactions, events, and arrangements within an accounting cycle. Now, we may have source documents, bless you, that don't record events, but we still have source documents. When we go and hire someone, we may have some HR paperwork. That necessarily isn't going to get transferred into the form of an economic event right away. But generally speaking, we will have these various types of situations within a business that through the source documents is how we record transactions. Now we've got a couple terms. Accounts. Everyone is familiar with the term account. Account is basically the terminology that we use that stores monetary information based on transactions, events, or arrangements. For the most part, I'm going to use the term transactions, guys, okay? So, the accounts are basically the storehouse that we use to record and to put various monetary information into each one of these accounts. The chart of accounts is a listing of all the accounts a company uses in its business. Now, chart of accounts has a name to it, and each account has a number to it. Each business may have a different set of chart of accounts. When we're dealing with Augsburg, we're probably dealing with various types of grant revenues that other companies may not deal with, okay? When we're dealing with manufacturing companies, they're going to be dealing with inventory. They're going to be dealing with work in process. Some of you guys are familiar with that from managerial accounting. They're going to have different accounts that a service industry doesn't utilize. So everyone has their own unique set of chart of accounts. Many are common, but the chart of accounts is basically the grouping of all the accounts a company uses. And we have our wonderful T account. This is just the way in which we house accounts to help make sense of how they increase or how they decrease by debits and credits. A T account, you guys are familiar with, right? Looks like a T. The left side is the debit side, and the right side is the credit side. Depending on what type of account you're dealing with, a debit may be the normal balance. A credit may be the normal balance, but a debit just means left and a credit just means right. That is it. Now, in our accounting cycle, we use what's called the double entry system. Each transaction event or arrangement, again, I'm just going to say transaction, uses a minimum of 2 accounts, sometimes more. So we will always balance. Whatever amount we debit, we need to credit that same amount so we balance. So the double entry system is the manner in which we ultimately perform the accounting cycle. Now, when we're dealing with the account classifications, we have some accounts that we don't zero out or close out at the end of the period, do we? We call those accounts permanent accounts. Think of them: assets, cash. On December 31st, if we have $1,000 at the end of the business day, December 31st, what do we start with January 1st? $1,000. We don't zero that out and start new. Our assets continue on unless we sell them or use them. So permanent accounts are those accounts primarily that are in the balance sheet. The assets, the liabilities, and all the shareholder equity accounts where the balances at the end of the period begin at the new period. The beginning balance is going to be the same amount that it was those balances at the end of the period. But then we have certain accounts that are temporary. Because we report income and expenses over a period of time, generally a year, when that year is done, we're going to wipe out those accounts, place them into retained earnings, and start new at the beginning of a period. So we don't say, for example, let's say Augsburg's revenues for all of 2014 is $5 million. Do we hold on to that money and then say, Augsburg's revenues now are $18 million? No, we start new every period, every year, every quarter, if we're measuring based on the quarters. So we have to zero out those revenue and expense accounts so they're clean, they're down to zero balance, so we start fresh every year. So those balances